Good morning, everyone, and welcome to Allianz's first quarter 2024 media conference call. Thank you for joining us today. My name is Frank Stoffel, Head of Financial Communications and Valuation Relations, and I'm here at our headquarters in Munich with our Chief Financial Officer, Claire-Marie Coste-Lepoutre. Claire-Marie will present our results, and afterwards we will have approximately 1 hour to answer your questions on our results. Today's conference call is scheduled for 90 minutes in total. We will answer all questions in English, but if you are more comfortable to ask your question in German, please feel free to do so, and we will repeat it back in English for everyone else on the call to understand. I would like to mention a few housekeeping items up front. If you want to ask a question during the Q&A session, press the Talk Request button on the web audio call or *5 if you have joined via telephone. If you are on an IP-based telephone, this may cause technical problems for you. If this is the case, please email media.contact@allianz.com and we can assist you with your setup, or we can take your question and ask it on your behalf. And now I have the pleasure of handing over to Claire-Marie.
Thank you very much, Frank. Good morning, everyone. I'm very happy to report our very good results for the first quarter of 2024. Let me start on page 3, and let's start with the group overall. Here you see a very good level of growth this quarter, with our total business volume up 7.5% at 48 billion. Our operating profit is at 4 billion for the quarter, which represents 27% of our midpoint outlook. And our shareholder core net income is up 16%, also supported by improvements on the non-operating side during the quarter. What I like is that all our segments are contributing to these results, and in particular P&C. Let me start with P&C in a slightly more detail, still on page 3. You can see the good growth, which is emerging in terms of internal growth at 7.5%, with very good pricing momentum in the underlying. Our combined ratio is stable compared to last year at a very good 91.9. You can see that we have benefited from slightly lower level of Nat Cat. We had a less release of reserves in the quarter as well. And in the underlying, our attritional loss ratio is developing in line with expectation as we are earning the price increase. So this aspect is very important, and I will further emphasize this as we are going through the more details on the P&C side. This is allowing us to emerge at an excellent operating profit at 2.1 billion, which is up by more than 10% compared to last year's same quarter. On the life and health side, we see as well a very good level of growth at an excellent new business margin, which is at 5.7, which basically allows us to generate our highest value of new business ever in a quarter at 1.3 billion. And our CSM release is leading to an emergence of operating profit, which is in line with our expectations of 1.3 billion for the quarter. On the asset and management side, we have seen very good level of net flows. As you can see, 34 billion of net flows in the quarter. We also had a very high level of performance fees this quarter, which together with cost-income ratio that is improving, allows us to deliver a very good operating profit at 800 million for the quarter. So overall, we had a very good start, as I mentioned already, into 2024, and all our key metrics in terms of growth, in terms of technical excellence and profitability were better than the full year 2024 assumptions. Let's now move to page 5 and let's have a look at our capital situation. So overall, here you can see that our Solvency II capitalization is strong at 203, slightly down compared to year-end 2023, which was at 206. In terms of sensitivities on the right-hand side of this page, you can see that they are slightly reduced compared to year-end 2023, which basically means that we have a stable level of solvency post-stress compared to year-end 2023. If we move to page 7 and we have a look in more details at the development of the solvency ratio, here you can see in the walk, so moving from 206 to 203. So in terms of regulatory model change, we have minus 1 percentage point of solvency capitalization, which is linked to the yearly update of the ultimate forward rate. Our operating solvency to earnings is within the range of expectation, which is between 6 and 8 percentage point. We are at the low end of this range for the quarter because we had higher growth than anticipated, especially in life. And this is coming with a timing effect. And here you should expect to see this investment into the growth to earn itself out during the year. On the market impact, we had a positive effect of the equity development, which has been offset by the update of the EOPA VA, together with a bit of sovereign spread widening and our ongoing mark-to-market of real estate that also did come into this market impact. Capital management and management action is minus 6 percentage point. Here you have the effect of the share buyback that we had announced last time, the dividend accrual, and as well the fact that we did have small M&As and some renewal of our distribution agreements that came into this section of the solvency ratio, meaning this is investment into future value creation and our actions in terms of capital deployment. Tax is as expected. So I will say when you look at the development of our solvency ratio and compare to a top-down estimate of the solvency ratio that one could have estimated to emerge stable given the market developments and what has been announced, we have three main drivers that explain slight reduction of the solvency ratio, 1 percentage point each on average. This is the higher growth. The second effect on the market impact, so related to the VA and the mark-to-market of the real estate. And lastly, the small capital deployment into our M&As, smaller M&As, and the renewal of our distribution agreement. So overall, we have a strong and unchanged capital strength versus year-end, I think. So let's move to P&C, and let's have a look at page 9 at the growth. Our P&C growth is strong at 7.5%, and this is well shared across the portfolio. This is mainly driven by rate, but with nuances depending on the dynamic of the markets. As an example, we have a higher rate change in the UK or in Australia, where we expect the inflationary effect to be the highest in 2024. We continue to have a build-up of rate on renewals, as the first quarter is above both full year 2023 and the first quarter last year, which was at 5.6% against the 7.4% that we see now. And in the underlying, retail is at 11% in terms of rate change on renewal. Commercial is still solid, with mid-corp up 6% and large corporate at 3.5%. Let's now go to operating profit on page 11. And you can see that our operating profit is very good at 2.1 billion and is benefiting from both the technical side and the investment side, as you can see on the walk. Secondly, our operating profit is running ahead of our midpoint guidance for the year. And if you look at our combined ratio on the right-hand side, our combined ratio, is better than the 93-94% range we have based our guidance on for the full year. So in terms of combined ratio development, if you start on the right-hand side at the bottom, you can see our expense ratio, which is improving. Then we have lower level of runoff within the loss ratio. That's linked to the fact that we had some negative development into some of the 2023 NatCat events, in particular in Italy and Australia. The Nat Cat impact for this year was lower. And as I was mentioning, and what you cannot see directly on this page, is that our attritional is actually better by 0.4 percentage point versus year-end 2023. And that's fully in line with our expectations to achieve a 1 percentage point improvement of the attritional loss ratio by year-end, as we are earning the rate momentum into the loss ratio. So this aspect is something we are carefully monitoring, and that's definitely confirmed in our results for the first quarter. Overall, when you look at the combined ratio, commercial continues with an excellent combined ratio of 89.9, and our retail portfolio is fully in line with our expectations at this point in time. Let's now move to page 13, and here you can see the translation of this very good performance across the portfolio, which is very good to see. So that's definitely a strong page, and you can see in particular that some of the operating entities where more actions was needed are emerging better, like the UK or Australia as an example. Let's go to page 15. On the investment side, we are up 19% versus last year as we continue to earn the benefits of the higher rates. Our interest accretion is fully in line with our expectation, and our economic reinvestment yield is at 4.3%, which is ahead of last year. So overall, on P&C, we had an excellent start into the year. In retail, we have a double-digit price momentum, which is earning into our combined ratio, while commercial continues to deliver steadily, both in terms of top line and technical performance. Let's now move to life and health on page 17. Page 17, you can see the strong new business momentum in the first quarter with our PV and BP, which is double-digit up, particularly supported by Allianz Life, Italy, Asia, and the German health business. We also had a large structured reinsurance contract in the first quarter. Our new business margin is very good at 5.7%, above our target of 5%, and all entities are delivering along those lines. So this is leading to a record level of value of new business of 1.3 billion. And what I find also really nice on that page is that you can see that 94% of this value of new business is from our preferred product areas. Let's now move to page 19 and let's look at our CSM development. For this quarter, the CSM walk is very simple. We have negligible economic variances, and the non-economic variances are in line with our expectations for the year. So this is here you can see directly our normalized CSM growth, which is at 1.7%, which is very good. That's slightly above our expectations for the full year, given the higher value of new business we have been generating. And our CSM release at 1.3 billion is fully in line with our expectation. In terms of sensitivities, they are very stable and they are basically unchanged compared to year-end. Let's move to operating profit. And again, a very simple page 21, where you can see the translation from the CSM release to the operating profit, with actually those elements which are more or less offsetting each other in line with our expectations fully. So we emerge with an operating profit at 1.3 billion, which is at 26% of our yearly expectations. Page 23, you can see the good developments which are confirmed when you look at it by entities, both in terms of CSM and operating profit. We are very much in line with our expectations, and I'm happy also to explain in more details if you want when we go into the Q&A. So overall for life, we have a very strong quarter. We see growth, we see our new business margin, new business value, which is above our expectations. Our CSM release and our operating profit are in line with our full year assumptions. Let's now move to asset management. Page 25 is highlighting the total asset under management up 3%. Let's move directly to maybe the third-party asset under management, page 27, where our third-party asset under management are up 4% versus the beginning of the year. We had a strong start in the year with 34 billion of net flows, which are stemming both from PIMCO and AGI, and that went towards fixed income and alternatives. On average, our net flows and the market movement take the asset under management up 5% versus last year, which I think is a good basis for the rest of the year. Let's now move to page 29. Our revenues here are up 5%. This is due to the higher asset under management and a very high level of performance fees, which are the highest in the first quarter since 2013. And this high level of performance fees is probably not something to be extrapolated for the rest of the year, but that's very nicely contributing to our performance in this quarter. Let's move to operating profit on page 31. Our operating profit grew by 7%, which is reflecting the higher average asset under management and the higher performance fees, while we had a good cost control with an improved cost-income ratio, both across PIMCO and AGI. So overall, a really good performance of the asset management segment in this quarter, I think in a volatile environment, and we have good prospect for the asset management business this year. Page 33, I'm going to skip because our corporate developments are better than planned and there is not much to highlight in terms of developments. And let's go to page 35 and have a look at the translation from our operating profit to net income, which I think this quarter is also quite straightforward. We have approximately 500 million of non-operating profit, where in particular we had lower impairments compared to 2023. With a 25% tax rate, which is fully in line with our expectations, our core earnings per share is at 6.42 euros, which is up 18% compared to last year, which is very good, I think, also in terms of forward-looking expectations. Page 37, let me summarize and really confirm that we had a very good start into 2024. Our total business volume is at 48 billion and growth is stemming from all segments, which is very good. Our operating profit is at 4 billion euros, which is 27% of the yearly midpoint. Our shareholder core net income is up 16%, and we have a strong balance sheet with a solvency ratio which is above 200%. So I think we are really well positioned to confirm our outlook at 14.8 billion plus minus 1 billion, as all our key KPIs in the first quarter in each segment are better than our full year 2024 assumptions. With this, I first of all would like to thank all our employees who have contributed to delivering these results. I think we can be very proud of the delivery in the first quarter, and I'm happy to take your questions.
Thank you very much, Claire-Marie. We now start our Q&A session. Just to repeat, if you want to ask a question, press the talk request button on the web audio call or *5 if you have joined via telephone. The first question comes from Alexander Hübner from Reuters.
Hello, good morning. It's two questions, in fact. The first one is on your recent statement here. You're saying, well, everything is better after Q1 than anticipated for 2024. What will have to happen in the next months that you can be sure enough to give a higher outlook for the current year? And the second question is the only slight disappointment to analysts expectations was the solvency ratio. Can you elaborate a bit why it has been a bit lower than at the end of last year? Thank you.
Yeah, so thanks a lot for your questions. On the outlook, I think we are, in the so it's only the first quarter, so those are, really good signs and very positive developments into the year. But this is only the first quarter, so it's too early to adjust our outlook. And secondly, we are always in an environment where we can see also Nat Cat happening and so on and so forth, and so I think we have to take that into considerations as well when we provide our outlook. So I feel very comfortable with the current level of outlook we have been providing and the fact that we are confirming it. On your second question on the solvency ratio, so I think indeed, when you do, based on the sensitivities we are providing and the indications of what we had announced, in particular the share buyback, but also like the update of the UFR, which was known. I think one doing top-down math could have expected the solvency ratio to emerge flat at 206 versus the 203. So we have 3 percentage points of small deviation which are related to the higher growth I was mentioning. So on the capital generation side, on the market side, we have this update of this EOPA VA and also the mark-to-market valuation of our real estate. And the last piece is associated to some capital deployment into smaller M&As that we did, that we have done in the first quarter of the year, and some of renewals of our distribution agreement. So those are the main drivers, and they come more or less for 1 percentage point each. From my perspective, a quarterly solvency ratio is not extremely relevant. You always have a bit of noise up and down. For me, what matters is that our balance sheet strength is unchanged and we have a very strong solvency ratio. So I don't think we should really be bothered, I would say, by this development.
Okay, may I ask another question, a bit detailed, but I think I remember you said that last year you had been profitable operating in the German auto business, and I just wondered whether this has changed in Q1, because many or nearly all of your competitors have been in the red recently.
Yeah, so that usually we don't comment on single line of business within a country. I can confirm that in the motor German portfolio, we continue to perform better compared to the market. This is more than 10 percentage point better in terms of combined ratio. I think remains the right indication. So we are. We need to manage well, I think, the profitability development into the motor business, because that remains a business to be carefully managed, if I may put it this way, because we see also the inflationary effect still in that line of business, and the increased effect, as an example, of some of the frequency items in this first quarter, associated, as an example, to the fact that we had some strikes, so people are using more their car, or as well the fact that we had one more day in the month of February, which is also contributing to higher frequency, as an example. So this is a line of business that really requires careful monitoring, but I really think that our German entity is doing a great job there.
Thank you very much.
Okay, thank you, Claire-Marie. Our next question comes from Friederike Krieger from Versicherungsmonitor. Friederike, your line is open.
Hello. I was wondering, this price increases in P&C you talked about. Can you elaborate a little bit on this? From which line of business they are coming, and from which countries?
Sure. So if you look at page 9, where you have a bit more details on the rate change on renewals, you can see that first of all we continue to see some inflationary effect right into our books. So that's why we need to inject further price increase. But it's very much to be nuanced by country, by line of business indeed, and even by sub line of business. So you can see the countries where we expect the higher level of inflation in 2024, as an example, UK or Australia are getting higher rates. We also see in the commercial business, you can see AGCS has a rate change on renewal which is at 3.5, and also an internal growth that is slightly negative. That's associated to the fact that some of the markets have been softening, typically financial lines, cyber, or aviation, where we are definitely not growing because we are not getting the price adjustments we need given the inflationary effect. I think on the rest of the business we are getting the price increase we need to adjust for inflation across the board. Yeah. So is that answering your question, or you would like to see a bit more details on this page 9?
No, thank you.
Okay, thank you.
Thank you, Friederike. Our next question comes from David Walker from Insurance ERM. David, your line is open.
Hello, Claire-Marie. Thank you for the presentation. I had two questions. The first question on surrenders. Looking at Allianz Leben, Allianz Italia Spa, and Allianz V, they're very different experiences, very different numbers, the ratios of surrenders to premiums, 30%, 63%, 72%. I wonder why there's such differences in Italy and France, and can you do anything about it? And are you concerned about the lapses in those countries? My second question, Claire-Marie, is about runoff of life books. Two of your big rivals have had deals stopped by BaFin, or they've abandoned those deals. Have you ever looked at selling off legacy life books to consolidators? And how do you view the climate in Germany at the moment? Thank you.
Mm-hmm. So maybe let me start with your second question on the back book operation. So we did a couple of. So I think in general, the Allianz Group is looking structurally always at ways to optimize the capital deployment. So we have been looking at operations on our back books. So we did a large one, which was a so-called Lucy transaction on our back book on part of our life books in the US, as you may remember. Yes. And we did as well smaller back book transactions for some of our European books, but small ones. I think you're right that in the current environment, given the rate development, I think doing life back books is a bit more complicated in the current environment. That's definitely the case from an economic perspective. I would think. For us, we continue to look opportunistically if there are good areas where this could be favorable for us to do in terms of capital deployment. But other than that, we also think that so we continue to look opportunistically at what can be done, and we are in general open, I would say, to performing a life back book. So for me, the key critical aspect, sorry, I'm a bit running around. The key element is really to look at how we can best deploy our capital while still delivering the best possible value for our customer, and that's what we try to balance at best in general. And then on the second element, in terms of of overall message when it comes to surrenders or to lapse rate. Our lapse rate in general are fairly stable for this at this point in time compared to what we have seen at year end. If you deep dive a bit more into the European market is better compared to the first quarter of last year. In particular, because we had a specific spike in the first quarter of 2023, which was associated with our Luxembourg business out of the French portfolio, and that did not repeat itself in the first quarter of 24. So in general, across our European book, we see a stable lapse pattern with some nuances. I think for the life business, the US book, our lapse pattern is a bit different because, as part of the business model, you see part of the business lapsing to be then reinvested. So there is a natural recycling of the business as people are seeking for the higher rates they can get in this environment. So as such, on our Allianz Life book in the US, we see a higher lapse rate in the first quarter of this year compared to first quarter 2023. It's approximately doubled, but what matters will be the net flows, and the net flows are positive for AZ Life in the first quarter. Does that answer your question?
It does. Could I ask though, Claire-Marie, just in terms of the German, is Allianz Leben looking to sell any policies, some German life policies, and do you see the climate in Germany being particularly difficult for back book, legacy book sales?
We are not looking at doing any back book operation of Allianz Leben, so that's definitely not a focus for us.
Okay, thank you very much. Thank you.
Thank you, David. The next question comes from Steffen via DPA AFX. Steffen, your line is open.
Good morning. Can you hear me?
Yes, we can.
Yes, fine. It didn't work for a few quarters, so I'm happy. Just two questions. In case I missed it, missed some differentiated tones. On the profit guidance, in February, when I didn't cover the Allianz figures, I think you said something that you expect to earn more money than the midpoint of your profit guidance. Is this still the same? And perhaps you said it, but I didn't get it now. And the second point is the Baltimore Bridge, where the reinsurers expect large losses, but can't tell us any figures yet. Is Allianz also expecting a larger loss, and from which part of the case, which is very complicated, I think?
So outlook, no, I definitely did not mention that I was expecting a higher level of operating profit for 2024 in the call last time. So last time I presented our outlook 14.8 billion, which is basically the rounded number of the year-end delivery that we had last year, which was 14.749, I think. So we did a round up to 14.8. And that's the midpoint. I think historically it always served us really well to take the profit from previous year as being the midpoint of the forward-looking year. So we maintain this one, and fundamentally in the underlying assumptions, I think the assumptions we use are very good assumptions also to still confirm the outlook for at this point in time for 2024. So I'm really happy to confirm 14.8 billion plus minus 1 billion as you mentioned. So the range is also offering opportunities for upside potential, but I'm very comfortable with our 14.8 billion at this point in time in terms of outlook. So then I think your second question, if I understood well, was related to the Baltimore Bridge event, right? So usually, we don't really comment on a single loss basis. For us, overall, we have no direct exposure to the vessel. So if we were to see loss developing, that would be more related to some marine PI coverages we do have there. But in any case, that's definitely extremely well manageable for us. It will be in the low double-digit million euros loss, and actually a part of that has already been booked in our Q1 results proactively. So you should not expect this to be a big event for us. Yeah.
Double-digit million in Q1.
No, I think I said like if this type of loss will be materializing more related to the more PI type of coverage, it will be in the mid double digit type, low mid double digit type of loss, and so that's the type of order of magnitude you should have, which for our large corporate book is small, really small.
Okay, thank you very much.
You're welcome.
Okay, thank you, Steffen. Just to repeat, if you want to ask a question, press the talk request button on the web audio call or *5 if you have joined via telephone. The next question comes from Jean-Philippe Lacour from AFP. Your line is open, Jean-Philippe. Jean-Philippe, your line is open. Jean-Philippe, if you have technical problems coming through to us, please reach out to me after the call and we will ensure you will get an answer to your question. Or alternatively, please try to dial in again to see whether we can fix the problems. Okay, we have no further questions in the queue. Please allow me to remind you that we will report our financial results for the second quarter on August 8th. We are looking forward to continuing our exchange then. This concludes today's media call on our first quarter 2024 financial results. We wish you a nice remaining afternoon. Thank you.